Hello everyone, this is Avijit Chatterjee recording our weekly session for Chartsarefun. This is for the week of April 28th, recording this on Sunday, May 4th. The market has come up in a V shape. As we know, it has been extremely resilient. This week, we had the GDP news that was negative. We then had the jobs, the non-farm payrolls. That came on Friday, but before that, on Wednesday, we had the ADP. The ADP was weak, got the market very worried with the negative GDP, which is primarily because of imports. Imports have a negative impact to GDP, a lot of front loading of imports ahead of the tariffs. But then on Friday, it was a positive surprise on the jobs. Pretty strong job report, which then got the treasury yields kind of going higher with the expectation that there isn't going to be a rate cut in the immediate term, though President Trump has been extremely vocal about of Chair Powell doing rate cuts on his behalf. We know that today we will primarily look at the chart trends, some of the key charts of QQQ, the S&P 500, IWM, VIX, the various oscillators of the Nasdaq, and kind of end with a positive tone. We do believe QQQ is setting up for a pullback, but then from the pullback, we expect it to break out and hit higher highs. So without further ado, let's go straight into our our YouTube site. Charts are fun. It's a channel called Charts are fun. We appreciate you subscribing to our channel, and then if you like the videos, if you hit the like button. Our blog site is in Substack. It's also called Charts are fun. We put out daily blogs in the morning, so if you subscribe to it through your email, you'll get them as soon as they come out around 7 a.m. We want to start off with Barron said an article over the weekend saying money managers is the most bearish in 28 years. That's going back to 1997. We know that there is, of course, a lot of concern about tariffs, a lot of concern about the new administration, their policies, and people are extremely worried about the uncertainty in the geopolitical climate right now, especially in the economic conditions with how the various countries around the world are going to react to Trump's forcing in higher tariffs and kind of changing the consensus on global trade. So that's a fear, but in many cases, these turn out to be contrarian signs, and we'll explain why we believe that this yet again is setting up as a contrarian sign. Too much of bearishness, we believe the market is setting up for a huge positive upside surprise. The economy shrinks in the first quarter. This was in the news on Wednesday, April 30th. The GDP was negative 0.3. That's the contraction of the GDP, primarily driven by imports, as the article says from Reuters, front loading of imports in anticipation of the tariffs. We know that Apple got a ton of their phones off India on plane and got them all over to US, knowing that they would get hit hard by the China tariffs and so on. So they got most of their iPhones off from India. A lot of that is manufactured in India these days onto US ahead of the tariffs. Also, the jobs data came out. The ADP was weak at 62,000 jobs, but the non-farm payroll and ADP's private payroll, non-farm payroll does have the government sector. Many were expecting with the huge DOGE-related cuts and so on, unemployment to creep higher. Turned out that was not the case. Unemployment stayed at 4.2, and the economy added 177,000 jobs. The expectation was only for 138,000 jobs for the month of April. So that's a lot of strength. Market is now thinking that perhaps, we may not get a rate cut. And this is the 10-year yield. We see that the 10-year yield shot up from around 4.22, close near 4.32, 10 basis points of move. 0.91 is almost from 4.2 to 4.22 to 4.32. So that was a fairly big move in 10-year yields. It's along a declining channel. We got to see coming into this week and then the next couple of weeks, if we can break higher from this declining channel, that would mean rates going higher would be jittery to the market. Market doesn't like high rates, and that could likely bring market down. So we're going to see what rates do. But at this point, it's right at the top end of the declining channel. Key is in this last, I would say 3-4 weeks in April, since that spike of VIX, which is the key fear index, it's also the CBOE volatility based on puts and calls out there, tremendous spike up to 60, last seen around the August 5th Japanese stock market sell-off from the caddy trade. That was 65. Peak came down very fast to 14 from there. In a similar way, we've been coming down very fast from that peak that we saw on April 7th. This is after the Liberation Day on April 2nd. Over the weekend, China's retaliation against US, a trade war came in from the market's fears. VIX shot up at 60 on the day on the Monday the market opened. Many were even expecting a 1987 kind of a stock crash. It really didn't get that far. It was maybe a 5% intraday pullback, but then the market recovered extremely well throughout that week. And in fact, a couple of days later, on April 9th, when President Trump declared that he's going to put a pause on the tariffs, the market had a huge rally that day. So that VIX, as we can see from 60, has been coming down the last couple of weeks. We can see this is called actually a bullish falling wedge, when you can kind of connect the tops and the bottoms along a wedge formation, narrowing down to a point where we think VIX could be setting up for a rebound. What we do see, VIX has come down to a key level at 22, 23. We can see in the last 9 months or so, VIX has touched 23 a few times and then pulled back. That which was resistance now has become support. So we are expecting VIX hitting a support from a falling wedge to kind of have a rebound, and hence a bit worried about a market having, from an overbought near-term condition, a pullback in the very near future. We also talked about this 10-year yield chart, TNX, along a falling channel. If that does break out higher, that would not be good for the market. S&P 500, that's hitting and testing a very key support level. That's at that 5696. You can see it tested it twice when it was coming down in November. What was then a support is now resistance. It hit that resistance on that day on when we April 2nd, the day when we before the market, it was after market close when the Liberation Day taxes got announced, but that hit 56.96. So that is what it came, and it just crossed above it intraday at 5700, but closed right below it at 56.86. We do believe that this band of resistance here, 56.96 to the next level at 57.73, 57.86, there's slight chance that the S&P could climb up to that level to test it, and then from there maybe pull back, because then this could be a nice inverse head and shoulder pattern, this being the left shoulder from 57.86 to 55.04, a big head from there to 48.35. That would then be the neckline at 57.86, a right shoulder at about 5500, and then a break higher. That's a possibility. We'll see how it pans out this week. But this pattern of when you connect the tops and the bottoms is a wedge in the other direction. While you saw a falling wedge pattern in the chart of VIX, this is just the opposite in the chart of S&P. It's a rising wedge. This rising wedge is narrowing down to a point where this becomes bearish. It typically breaks below, and if it breaks below, then we could expect that pullback towards that 5500 would now be a very key support for it to come down and test. Now, from a Fibonacci, for those that believe in Fibonacci, 6147 to 4835, that's roughly 1312 points. So if you take 1312 points and take half of that, that midpoint, that 50% retracement level was at 5491. Some of the technicians were watching it. We did cross it. And in fact, this week, we gapped higher after some very strong earnings this week from Microsoft. Had a huge 9 to 10% move after earnings. Unbelievable for a $3 trillion stock to have just about 300 billion added to the market cap in a single day, but a massive move in Microsoft stock after the earnings on Wednesday. The entire market gapped higher from Wednesday into Thursday, while just that day before, on the day after earnings, that day is when the negative GDP came out, and we can see that the market did tank lower, tested the low end of this rising wedge, and then from the rebound, it gapped higher on Thursday and into Friday after the strong jobs. Market reacted strongly to it. It further rallied. So we had two good trades of rally. So market is now, as we can see, at the top end of that wedge pattern or the trend line, and we shall see how it ends. Similar kind of rising wedge pattern on the small caps. If you join the peaks and the lows, it's also hitting a very key. This is the small cap ETF called IWM, a very key resistance level as a 202. It's getting closer and closer to that. Intraday it touched 201 and closed right at about 200.48. So another point or two it could climb and then maybe hit some strong resistance. So we're looking for that as where the small caps could kind of have a near-term resistance and pull back. And in the QQQ chart, which is the Nasdaq 100, the largest of the technology stocks are in here, all the $1 trillion Max 7 stocks. We can see a similar kind of rising wedge, a very sharp climb from 402 to 490. We had an intraday 490.91. So we see a decent level of resistance at 493. Look at 493 here in November. That was support, which is now resistance. We saw that resistance level on the day of the Liberation Day, kind of, in fact, this was not even Liberation Day. Liberation Day was on April 2nd. In late March, we had seen that 493 level being tested. So that is where we think a neckline is potentially forming. We'll shortly show you the pattern, but we think that there's a potential. Another few points, we closed near 488, 4 or 5 points to 493 is where we think QQQ could, for the time being, hit some strong resistance and pull back, maybe towards the 465 is what we think it could do. Now, it's been in the tweets a lot in Twitter space. Many are comparing the current market pullback to what happened in 2022. In 2022, the top was at near 399 around late November. It tested, came close to it at 396 around late December, and from there broke down. So 399 to a breakdown level that it hit, closer towards 263. That was almost like uh, uh, actually towards the 311. 263 came a lot later. Towards the 311 from that to 399 was almost a 22% drop. And from there, it had a rally. It had a fairly V-shaped rally, but then guess where it failed? Right at the 200-day moving average shown in red. So it failed at that, and then from there, it broke down to a lower low. So many are comparing this kind of a failure at the 200-day moving average is exactly what the QQQ is setting up for again, like in 2022, and break down below 402 to a lower low. That's what the bears are looking for. So the bears are thinking that if that's 540 to 402, this turned out to be actually a much more sharper pullback, closer to almost a 26, 27% pullback this time. But from the V-shaped recovery, fading at the 200-day, and then from there breaking lower. So this candle was kind of an evening star doji. For it to have confirmed, we should have expected on Friday a negative candle, which we did not get. We got a upward candle, but it did stop right at the 200-day moving average at 489, 490 is where the 200-day is. So we'll see if that's what the bears are expecting, this to be not just stopping at 465, but a sharp pullback like we got in 2022, and this kind of coming down to lower lows is what happened in 2022. So we shall see if bears are correct or not. Near term, some of the breadth indicators like the McClellan oscillator, it shows extremely overbought. It had hit 80, close to 85, that it hit back in mid-July. If you remember mid-July last year, we got a very sharp sell-off in semiconductor stocks. Many of the Nasdaq technology stocks that got sold off at that second half of July into that bottom around August 5th Japanese stock market low. And a similar kind of move, a very sharp move from minus 77 to 85. We did start getting the pullback. We can see that the MACD histogram has begun to curve lower. Typically, when these curves come, they come lower, they dip below the zero, then they curve back higher again. So these are beautiful bell-shaped curves going up, declining, bell shape below the zero line, then back up again. So that bell shapes keep rotating back and forth. And we are in that process of that bell shape now declining back to the zero, going below it, which means if you count each bar in here in this histogram, these are daily chart, these are days. So you could say another maybe next 5 to 8 days, we could go below the zero line and go back higher. Like maybe, it happened here, took a few days for the bell shape on the bottom to form up. So we are being cautious in the market, thinking that we are at an overbought level on the oscillator, which is really determined by the advanced decline, how many stocks are advancing to declining. And that could weaken, and as there are more decliners coming in, which means market has a downward pressure to come down, the Nasdaq could come down, and that could be watching this NAMO chart and watch for this histogram to break below the zero line, start forming a nice curve, kind of a peak on the bell on below the zero, and then you could start timing in and thinking that you're going to start getting a market recovery. So this says time to be cautious. In a similar way, if you look at the advanced decline, this is the not the cumulative, but the actual advanced decline. Every candle is the day of advanced decline. We can see that the advanced decline closed at 2,057 net advancers in the Nasdaq not the Nasdaq 100, but the entire exchange of Nasdaq. 2,057 stocks were advancing that day on Friday, at the end of last week. But we can see there's a pattern of declining tops: 3,073. 2774 to 2057. That declining top indicates market's breadth is deteriorating as it's climbing. In a similar way, kind of rising bottoms, it was minus 3098 on the April 7th low. Has recently was minus 2072 on Wednesday when we got the negative GDP print. So this could be coming back lower, and we can see the same kind of histogram dipping below the zero for a couple of days and just slightly moving higher, but you could get it come right back down and kind of form a curve like we saw here below the center zero line. And as it curves and kind of forms a nice bell shape, that's when we can expect the market to kind of bottom out and rebound higher. So that's that. And then a couple of things that are on the positive side is the overall market summation index, which is a cumulative measure. Those two that we showed here are absolute advanced declines to show you the oscillator and the advanced decline line. But the cumulative summation index, which is also an advanced decline based market breadth, has been climbing, and it's been climbing since that low around April 9th or so. And it's been climbing higher from a deeply oversold at the RSI of 10 is now at RSI of 78. We can see that when it gets above 70, it could be up there for several weeks, 2 to 3 weeks, before it comes back down again. Typically, these up cycles means market spread is improving. Market tends to be positive bias of rising. And then as it comes down, market tends to come down. But right now, NASI is showing that it is climbing. And if you look at the weekly chart, this is the daily. If you look at the weekly chart, you can see that typically monotonically when they rise for 8 to 10 weeks at a time. So you can see 1, 2, 3, 4, 5, 6, 7, 8, 9 weeks that it rose in 2023 out of a oversold level. That was minus 1,085. This is minus 1,008, a higher low from the two previous lows. At 2022 had 1180, here at 1,085, and here we are climbing off 1,008. We've only 3 weeks of climb, and we could another 5 to 6 weeks. We could easily be climbing further higher highs on this summation index, which means the RSI on here is right around 53 on the weekly. This could go climb towards the 70 level, as we've seen when monotonically they climb from the 30 level to the 70, 30 level to the 70. Here from below the 30, it's at 53. It's got a few more weeks to climb. So market could have a positive bias that then sets us up for what we think an inverse head and shoulder pattern is what could be forming. We are right at a very key neckline resistance at 493, as I mentioned. That also happens to be close to its 200-day moving average at 490, 489.81, 490. So we could effectively test this resistance at 493 and then pull back to form a right shoulder like we had a left shoulder here in March. So from 493 to 465, talking about roughly a little less than 30 points, maybe 28 points or so, pull back from there. And then after the right shoulder forms, we expect that there could be a very bullish upward swing. Why? Because of the summation index having several more weeks to climb. This means this pullback could be a shallow pullback, maybe over a few days, over the next 5 to 8 days. As that pullback comes, we expect the oscillator to carve out the histogram below the zero line, form a kind of a bell shape below the zero, and then start climbing. So we expect in the next week to 2 weeks, just in time for the options expiration coming up in 2 weeks from now, retracement of QQQ towards that 465, and then from we could have NVIDIA earnings coming up towards May 20th around typically third week of May or so, could set us up for that upside swing. NVIDIA could be extremely bullish earnings. We know that the Max 7 have been talking about very strong CapEx spending on NVIDIA chips. They have not reduced their CapEx whatsoever. Amazon, they all have been very bullish. Google all have been very bullish on continued spending on CapEx. NVIDIA could have strong blowout numbers, and that could power the market higher, in particular Nasdaq. So with that, good luck investing. We just are wrapping up saying that we do believe the market is near-term overbought. We can see that in the oscillator. You can see that in the advanced decline lines forming higher, kind of lower highs, indicating that there's a possibility of that pullback setting up. We expect the QQQ to be the key barometer here. We also expect from the VIX that kind of a falling wedge to have a rebound, as in VIX may be shooting back up towards the 30 to 35 level. And as VIX kind of moves back higher, we expect the Nasdaq to pull back, QQQ in particular, towards the 465, a shallow pullback on the right shoulder, and then a big breakout higher above. The measured target on this, by the way, if it does pan out, you're talking about 402 to 493. That's roughly 91 points. Add that to 493, 484, 584, 585 is where we think this upside target is. So much higher than the 540 that we saw in the February peak. So decent upside for the bulls. However, if the bears are right, you have to be always cautious. And it turns out to be like the 202 time frame, when if after testing the 200-day it breaks down to a lower low, then in that case, of course, we could see Nasdaq go even below the 402. We think it's unlikely. We shall see how this all pans out. Good luck investing. We'll talk to you next week. Thank you.